We live in a time of global transformation. The Energy Futures podcast explores how we can accelerate the expansion of clean energy technologies and reduce our reliance on fossil fuels. From heating and cooling our homes to moving around our planet and beyond, we bring together researchers, scientists, business leaders and communicators to exchange knowledge and try to answer one important question. How can we create a sustainable energy future for all? This podcast is produced by Energy Futures Lab of Imperial College London.
In this episode, we're joined by Dr. Malte Jansen, Lecturer in Energy and Sustainability at the University of Sussex. Dr. Jansen discusses the impact of the new UK energy bill on renewable financing, the economic viability of offshore wind farms, and the evolving financial structures and policies crucial for advancing renewable energy.
Brilliant. Thank you, Malte, for joining me today. We actually recorded a webinar with you 3 years ago during COVID called Subsidy Free for Offshore Wind. I'd like to kind of know what's happened in those 3 years, if it's still exactly the same, or with the new government, is the subsidies changing things?
I mean, it's a good question, right? Because it's a time for reflection, I guess, on what's happening in the world, but also happening with my own research. And I think that's those two strands I'll probably go into one at a time. I think the world has, somewhat changed. We're talking about finance today. I think that's the sort of introduction to the topic that I may make. And that particular study, while we're diligent in getting the right numbers, the picture has changed, right? The narrative has changed because we've sort of come out of a period of 15 years of zero or low interest rates for sustained amount of time after global financial crisis, obviously. And that really impacts renewables in different ways other than fossils, because lots of the fossil, the upfront cost or the lifetime cost of a project, the lifetime cost of what you pay over the lifetime of the project, the upfront cost of a fossil fuel plant is relatively low because most of that cost is in the fuel that you buy over the years. And that, you don't have to borrow that one because you buy the fuel, you burn the fuel, maybe it sits in the yard for like a year or two, but it doesn't stick around very long typically. So like the prices for selling electricity and buying the fuel are they move together. Whereas with renewables, most of the cost that you have is upfront, so you need to borrow that money, and the more you borrow, the more expensive it gets, and the higher the interest rate is, the more expensive it gets. So they're affected in different ways by what has happened in the last 3 years. COVID, sort of supply chain issues, and also like obviously interest rate going up. I think that's
So there's been a few changes. Some things are still similar. So the government seems quite ambitious in their plans for zero carbon, accelerating some things, slowing some other things down. Accelerating things in growth obviously costs money, potentially money that we may not have. In terms of the new direction that this government wants to go in, I think what are the biggest challenges from a financing point of view?
I think if we look at the renewables generation side, the solar PV, onshore wind and offshore wind, those are, I would say, safe investments in terms of return on investment. It takes a lot of money, but over the lifetime of those projects, you're saving a lot of cash by building those projects because you don't have to buy fossil fuels and burn them. That's the whole idea behind this, and that's why we're doing this. But it does save you money. So like as a whole, even if you have to upfront the investment somehow, and the question is how do you do this smartly? Because if you affect how the cost and the conditions of that investment, it makes the overall project cheaper, and that's part of the policy schemes that the UK has introduced some while ago with the contracts for differences. I think those things are relatively feasible to do. There's a question around energy system integration and first electricity system integration. So how do you get more power into the grid? How do you get the power from where it's generated to where it's being used? Typically produced Scotland or in the North Sea. So that needs to be transported down to large part to the southeast of England. Not everything, but to a large part. So we need to think about that integration, how to build infrastructure around that. And the second one is the energy system integration, where decarbonizing our homes, decarbonizing our transport, decarbonizing our industry are big challenges, and I'm sure you're going to cover this in other parts of the podcast series as well. But there's a good argument to be had that we need to be looking at infrastructure. And when you look at the things that we're trying to build, as we're moving away from a world where the upfront investment, so like the capital expenditure, we call this capex in finance terms, is relatively low. And the operating costs, the operating expenditure is relatively high, seen from a lifetime of an asset. For example, if I make it tangible, a car, like you buy, I don't own, I live in London, so there's no need for me to own a car right now. But if you were to buy a car, a petrol car is relatively cheap to buy, sort of on the lifetime cost, but relatively expensive to run because you have to pay for fuel and you have to pay for maintenance. With electric vehicle, it's a little bit the other way around. Your upfront cost is a bit higher, or at least sort of in a broader sense. But running it is cheaper because electricity is cheaper to buy and the car is cheaper to run. So, and looking at other technologies, if you look at grid infrastructure, it's the same cost structure, right? It's a lot of capital that you put up front on the table, like building wires, building transformers, building substations. All those kinds of things are assets that typically last 30 to 60 years. So you pay for them now in full, and they have relatively little cost over the rest of their life. The fundamental way we do things in terms of building stuff has changed in terms of the cost structure.
And how's that impacting on upfront capital? So where does this, in terms of, we were to pivot back to renewables and even wind, where are these upfront costs mainly coming from?
Well, physical stuff, right? Like the building the towers, building the blades, building the generators, building the grid connection. Those things are, material costs where you have to construct something and do something with it. I think one of the part of the discussions that is not being had enough is thinking that this is, it's not just money you spend. It's not just like opening your window and just throwing out £10 bills or but there's jobs created behind that, right? Someone's doing building turbine towers, someone's building foundations, someone's laying a cable. But I think we have to be conscious that we need to think about finance harder than we did, because it matters more to the overall cost of those projects. And so and coming back to the first question on the subsidy-free offshore wind, partly the reason why this has happened is because the government has put in place I don't want to call it subsidy scheme anymore, but a de-risking scheme for investments. And that de-risking scheme for offshore wind investments has brought down the cost of capital enough, make it bankable. It's just a buzzword, but what it means is you can load a sufficient amount of debt into your investment, and the logic is debt is cheaper than equity, and then that can fund those projects much cheaper, which brought down the cost for the consumers, right? Just by the government saying, we'll give you this, it made it more bankable and it got cheaper. It may never have happened without, policy will and policy drive towards that.
Is it possible to operate offshore wind farms at the current price levels that they're at now, or does that need to change? Possibly.
The some of the German wind farms, right? They've bid for their tariff scheme. I'm trying to move away from subsidy because they're not getting a subsidy. A subsidy would be something where there is a financial payment. The financial payment will only ever be clear at the end of the project. So if I issue a tender now for a contract for difference, what the government does, they know in 20 years' time whether any actual subsidy was paid, because it depends on how that tariff that they're getting through the contract of difference is in relation to the wholesale market price.
Right.
And coming back to the last 2 or 3 years, like if you look where the market price went, suddenly things were like, that was a good idea to build those offshore wind farms because they were cheaper. Coming back to the question, when is it possible to build them subsidy free? And then the answer is quite likely yes, because they're doing this in Germany, right? There's a couple of, not just a couple, there's a large number of wind farms that essentially not getting any payment, not any tariff. They're getting zero tariff. Actually, they're being charged extra. So there was a sort of reverse auction saying like, how much are we willing to bid? How much are we willing to pay for the right to use the seabed in the German Bight? And that the same has happened in the Netherlands as well. So there are examples of there. I do caution that we might not be reaching those ambitious targets relying on a couple of gigawatts here and there being built on merchant terms. But I think we need to have quite strong political will displayed through policy schemes that tells actors like, we want this and we're willing to de-risk this and we're willing to pay for this if needs be.
Amazing. So we talked about projects in the future and projects being built over a amount of time, which probably leads us on to inflation quite well. So what's the impact of inflation, and how does inflation impact the costs and financing of renewable energy projects?
I mean, inflation sort of drives up financing costs for everyone, right? There's when you look at the actual cost on the weighted average cost of capital that the project takes on to finance something, inflation sort of drives the baseline, and on top of that baseline you have a equity risk premium that is determined by where you are in the world. Investment in the UK has a different risk profile than investment in Germany. They're similar countries, but they're different profiles, and they're determined, for example, by the policy schemes. Like a stronger de-risking policy scheme will have a lower premium. And then you have a technology risk premium as well on top of that. You pay a certain amount extra because the technology is novel or the technology is well established. That gives investors a different perception and a different valuation on how risky that is perceived. And that has moved. So what inflation does is sort of raises the base. But the same happens for fossil fuels, right? Like if I want to build a new fossil fuel plant or if I want to build a nuclear plant, same issues arise, maybe in different different severity, coming back to the upfront cost versus running costs. But at the same time, like other cost components have risen as well. The reason why input materials into renewables have gone up is because fuel prices have gone up, right? Like that's the ultimate the ultimate reason. So that has all gone up as well. So with inflation, what changes is the baseline. What doesn't necessarily change is those premiums on top, right? Like, I mean, those premiums are over the last decade or so have been minimized quite a lot by getting to know the technology and getting to know the way we do things in a much more proficient way. So that there's a confidence there and a willingness for investors to take certain risks because they understand the risks. Like if you went to a bank 10 years ago, you had to explain to them how to invest in a renewables project because it's different than oil and gas. Like it's a different animal that they have to deal with. I think if you do this nowadays, you get a much more, professional response from our banks. Like, yeah, we understand the risk because we already have like 20 projects on the portfolio, and they're all performing well, by the way.
It must be really difficult to finance these projects like minefields because, like you said, there's so many variables. You're talking about a project that might take 15 years to develop. Anything could happen in 15 years. You might have global pandemics, wars, financial crises, etc. So there's so many different variables that they have to factor in the risk in terms of doing these projects. And I suppose that's one of the benefits of having energy mix is because if one's not performing or producing in the way that you want to, you've got others to fall back on. So back to finance structures. How and I don't mind where you want to go with this, if you want to stick with renewables or talk about grid or talk about consumption, but how are these financing structures? What do they look like?
I mean, I'll probably stick with renewables because I like to talk about things that I actually understand something about, rather than, I don't know how grids are necessarily financed. I understand the structure, but I don't know how a national grid is actually financing and raising debt. But with renewables, and especially offshore wind, but also like to some extent like big solar PV and onshore wind projects, they are typically utilizing non-recourse finance, which means it's a project-based company that is being registered, which is separate from the sponsor company. So they call this a special purpose vehicle, and within that special purpose vehicle, the debt is being taken on, the equity is being put on by the sponsor, and then from that financing, you build the asset, and the asset, the wind farm, the solar farm, has to pay back the debt entirely without any sort of money coming in from the sponsor, so that you sort of shield the balance sheet of big companies from possible underperformance, and that's one of the stories of success in renewables, having been able to do those SPVs in a consistent manner, because it creates the confidence that you can service your debt, and it comes back. I mean, I've thought about like, how do I make this tangible, and one of those is like, you look at your mortgage, right? Like it's not too dissimilar. The equity is your down payment that you put down for the mortgage, your 10-20% or something like that, and the bank provides the debt, and your eligibility criteria, how much you can borrow, depends how much the bank thinks you can service your debt. And the worst thing that could happen is that you're not paying back your mortgage. Like the mitigating measures in place that the bank give you holiday or something, but in essence the bank wants you to pay every month your mortgage rate. And that's the same with a renewables wind project or solar. They have to service their debt, and the income that you get from generating electricity is what you use to pay back the debt. And that's getting that right is an interplay between what the developers do, but also what policymakers need to understand or have understood actually when designing those policy schemes. The UK has done exceptionally well with the construct for differences scheme, so much so that it's being copied now in the European Union, even after leaving the European Union, which is quite interesting.
It is, and we kind of covered a bit this debt versus equity kind of equation, and understanding how shares and costs of debt and equity are comparing the financing renewable projects. Is that commonplace, not just in the UK, but is that commonplace across the globe?
Yeah, pretty much. I mean, it's not. Part of that is the risk profile of the investors, right? Like you want to call it equity stake because you get part of the company, and debt is, something that is provided to you and you pay it back. It's like your mortgage. That's a debt investment by your financing bank into your asset, which is a house, and they just want the money to be paid back. Whereas the equity holder is exposed to much more risk. So if the house prices go up, the homeowner has more money in equity. If the house prices go down, there's a risk as well that the homeowner is losing equity. And but I mean, fundamentally speaking, these are the two types of financing that you get. There's in-between bits based on the sort of investor type that you have. And over the last sort of 10-15 years, we've seen a gradual shift from higher risk investors to lower risk investors, and one of those lower risk investors is pension funds. Right. They're highly risk averse, but they can take a debt or an equity stake in the project. But what characterizes them is a low interest rate, right? Like no appetite for losing money at the trade-off of getting less interest on the investment.
Brilliant. So we've kind of looked at sort of maybe like bigger projects, but what I'd like to quite touch on now is the smaller projects. So in terms of like community energy projects, how are the financing models are working around that? And also, if there's anyone listening to this or watching this that are interested in it, I'd quite like to know what should they be doing, what should they be thinking about if they're interested in a community energy project?
Yeah, I mean, it's an interesting one because community energy projects have benefits for, get the buy-in of the general public. If you do this right, then you can create, I guess, an excitement on producing your own electricity or being part of a community. I'm myself part of a community energy project which has just gone live. I will not name any names, but the people who know might know. And I have thought a lot about the financing aspect, right? Because the way this has happened from my perspective is I make a down payment. I mean, obviously I fired up a spreadsheet. I'm a scientist, right? Like I fired up a spreadsheet. I put in the numbers and the numbers checked out for me. I looked at the location where the wind farm is. So obviously this worked out for me, but the customer journey on that is different. Like the financial aspect isn't necessarily at the forefront. Is the feeling that you want to do something good, is the knowledge maybe from what we do, communicating, that this isn't actually expensive. People know that they're probably better off, but they do make decisions with imperfect information in this case, and which is not something banks would do. Like banks would look at the project details in much more, they do much more diligence on where this is going. And I don't think community energy projects necessarily operate the same way. What always, or not always, but quite often I would think happens with community energy projects, you have that, the equity buy-in. Like I've provided equity to that project, like by making a down payment, I'm a shareholder of that community energy project. And then the banks will see, there's a healthy equity base that they provide debt anyway. So there must be, if you're doing this right, if you want to have a cheap wind farm, you need to bring in debt at the same time as well. Yeah,
that comes as part of the package, I suppose. When you're investing in it's like we're investing in anything. It comes with a debt and a risk.
Yeah.
So a couple of things just to touch on there. Well, firstly, I think the community that you were involved with this energy project must have been really happy that you were a part of it, being a research scientist in financing renewables. I definitely want you in my little community energy project. But so for people that are listening to this that might not know what it is, what is a community energy project?
Good question. I don't actually know the definition of that. I mean, I would think, in a broader sense, the opportunity to co-own and to engage with the community, that there's a link between, where it's based and where it's being used. But in my case, I mean, the community that I'm part of doesn't have a spatial restriction. Right, the wind farm is actually up in Scotland.
Well, what's the legal setup with it?
It's a cooperative. That's the sort of special purpose vehicle. In this case, it's the cooperative, right? The cooperative is put away from the project sponsor. The developer has said, like, no, this is the wind farm will operate in that cooperative, and the cash flow of that cooperative is ring fenced from any woes that might appear in the market with the sponsoring company.
So that's really interesting, because I always just had it in my head that a community energy project, say it was investing in wind, it would be near the turbine itself. You'd be able to see it from your village or town, but actually doing what you're based in, live in London, that's not going to happen. No. So obviously it's a few hundred miles away. So that's really cool. And is it always wind, or is it the solar powered projects as well?
Yeah, I mean, I think that's about to change with the Labour government having effectively scrapped the effective ban on onshore wind in England. So with that, we might see more projects being constructed in England. That said, the wind resource is better in Scotland, right? Like there's a reason why you build wind in Scotland, because it's one of the windiest places in Europe, and it's relatively close to consumption centres. It could be solar PV. I think wind makes more sense in the UK, because I'm not trying to comment on today's or yesterday's weather, but the energy you get from wind is significantly higher than solar. Right. And it makes the integration into the grid a bit easier, just by the virtue of being more available.
I'm definitely going to jump on onshore wind now, I think. But just for the listeners and audience, we will put in the show notes everything that they need to know about community energy projects, any useful links. Malte, if you know any good links that we can put in there, that would be great, or any types of content. So let's talk about onshore wind then, because obviously a lot's happened. As we're recording this, it's the end of July 2024, and we've just the offshore wind ban has just been released. Do you call it released? So how's that changing the landscape now? Why is that going to be such a big thing in the UK?
It's because with onshore wind, I think the planning system prevented onshore wind from being built in England, and I think in Wales as well, which means you build the turbines in Scotland or you go offshore, and you can transmission problems. Like there are certain parts of the country that actually in England that have a good wind resource, but don't have the ability to build those turbines. And by even in situations where the community wanted an onshore wind farm, it wasn't allowed. As a consequence, it wasn't allowed to build a wind farm. Coming back to the community energy one, I suppose the changes won't change. They won't affect the build out immediately. You're not flicking a switch. This is years and years and years of development, or in this case, years and years and years of no development. So any developer that wanted to build an onshore wind farm in the UK would have had to go to Scotland, and lots of them did. Lots of them actually have done that, and there will be no projects in the pipeline. There will be problems filling that pipeline, which might take half a decade for the first projects to materialize. So keeping that in mind, there's no quick fix. The timelines on onshore wind are a bit more favorable than offshore wind, but developing offshore wind farm until construction probably takes a decade. So the things that we see coming to fruition now have been in the planning for a long time, and I think there's a underappreciation on how much policy continuity there was in the background, away from the headlines as well. There's a lot of noise sometimes, but on the sort of civil service level and on the operational level, things have been put in place to keep the momentum going, even if there was. I'm not quite sure that's the case for onshore wind, but I think those projects, if there are good sites, will start up again. I think the main hindrance here might be grid connection, because you put those wind farms where it's windy, and where it's windy usually there's not that many people, and those don't have big wire connections to the bigger grid. So we need to tackle that, I think, jointly if we want to have any sort of uptake on onshore wind in a significant number.
Are we going to see lots of changes now? Are we going to see things happening at pace, or do you think it's still going to take a little while for things to unravel? I'm
hopeful that it's quick, but I'm skeptical that it will be. I think there's a lot of inertia in the system, and the focus has been so heavily on offshore wind in the UK that we might see the uptick first in offshore wind, because those projects are in the pipeline. There's tens of gigawatts in different various stages of development. Whereas with onshore wind, it's a bit more fiddly, especially when you look at those big headline gigawatt numbers. Delivering those onshore is hard because you need to actually deal with the local community. You can't just put a 3 gigawatt wind farm anywhere really. There's no place in the world where you can easily build a 3 gigawatt wind farm. I mean, there's some big wind farms in Texas and China, but generally speaking, you build maybe 10, 20, 30 turbines, but you don't build hundreds of those in one go. So accumulating those numbers will be a tough job.
Of course, in any green manifesto, one of the main components of that is public buy-in and trust. And I know 20 years ago, wind had a lot of pushback. There was a lot of people that didn't want these big turbines in their gardens and their doorstep of their villages and towns. But I feel like things are changing now. I think people see that that we need them. I really like looking at them, to be honest. We had a guest earlier today that was talking about one full rotation of a offshore wind turbine can power a house for 2 days. Yeah. And when you see them all spinning away over in the ocean, that makes me feel good, because you can start to get a feel of how much power they're producing, and they're getting bigger and they're getting more powerful, which is incredible. I think we've covered the UK really well here, and I think there's some great insight there. But I think as we sort of start to bring the conversation to a close, I think it would be great to look at the rest of the world. I think someone that maybe gets missed out of the conversation in terms of a transition, or should I say a just transition, is the global south. So how does in terms of financing mechanisms in the global south, how does that look different?
Yeah, it's like there's sort of challenged in several ways. The investments of relevant, wind, solar, battery, storage technologies is more expensive by the virtue of, having high interest rates. There being, the higher risk premiums. Coming back to the premiums, like the risk perception of investors on how much return they need to make that investment comes down to how risky is the general environment that you're investing in. If you go to a country in the global south, maybe the regulatory setup isn't as sophisticated as in other parts of the world, but you're also exposed to currency risks quite significantly, because typically those projects pay out in local currency, but all the components and stuff that you buy and that you build is being imported either on a euro or dollar basis. So there's a significant currency risk that needs to be balanced out, and also they're losing out on the value creation, right? Like if you this my point earlier, like if you build a wind farm, but you import 95% of the components and the value that comes with those components, then you're paying someone else to do that. You don't capture enough of that value, and there's a lot of drive in capturing that local content right now. But those projects need to happen first, because the aforementioned, higher cost of capital will challenge those investments much more, to the point where, if you have a reasonably high weighted average cost of capital, then half the project cost is really financing. It's not about the stuff that you buy, but it's about the money that you pay because you're being perceived as relatively insecure.
And the outputs, that access to markets, and I suppose is there in terms of knowledge exchange, is there ways that we can support communities in the global south through the ideation and the results and the impact that we have from the smaller energy community projects, the smaller energy delivery models? I suppose that's something that we can support countries that don't have the same resources as us and capital with that kind of knowledge and that kind of training and information.
Yeah, I think there's definitely efforts going on with knowledge transfer. There's good examples where this has worked. Quite often this is tied to development aid program or through development banks. They have the ability to take on a different risk profile than a private lender would have, because they're like, there's a portfolio approach with the added sort of benefit and value of developing the economy in those countries. I think we need to be careful on over explaining things to countries in the global south. I think they're really well aware of the challenges that they have in terms of climate change, in terms of mitigation, adaptation of climate change, and I think they are very well placed to tackle their own problems. I don't think it's necessarily a transfer of money needed, but enabling them to do things on their terms, and taking away the difficulties that come with that. And part of that is allowing them to formulate policies with a sort of equal measure of sophistication that brings down the cost of finance, amongst many other things, right? Like, we're talking about finance here today. There's a lot of other things to do.
Of course. So we have in our audience, we have students, undergraduates, postgraduates, postdoc, that are looking to take their skills, their knowledge, potentially their research into the green financing area. It'd be quite nice just to touch on now your journey and how you've arrived and why your research, how have you landed here in doing this type of research?
So I'm an engineer, right? Like, I'm an engineer by training. I've done a degree in Germany, half engineering, half economics. I took an interest in renewable energy, so that was the degree, and then got interested in electricity markets, because that was really important, or is still really important. Like, how we design those markets does matter. Took an interest in policy making, understanding how policy making works on a governmental level, and how those policies, like not politics but policies, are designed. And it dawned on me, and maybe go full circle on with the paper that you mentioned, it dawned on me that part of the cost reductions that everyone's been talking about, and part of the development, isn't down to making stuff cheaper. It's about how we finance those things, matters in a much larger share than I had ever anticipated. And I'm probably guilty of starting my career as any interest rate that I needed was 7%. I open up a spreadsheet. Everyone else is using 7 or 8%. I probably put in 7% if I'm honest. And it dawned on me, it's oh, this is only half the story, right? I've missed a bit here. And that bit is actually quite interesting. And so, as a researcher, I was like, oh, I've been blind on both eyes. Let me, try to see a little bit more on this one. And then essentially, everything that I do follows data. So looking at the data is this is an interesting story that's emerging here, right? And there's not that much research being done, because lots of that knowledge is within private institutions, right? Banks, financiers, equity providers, those are somewhat ahead of what research is doing, which questions the role of research, right? We need to add value somehow. As researchers, we need to think of the societal goals. And for me, it's that bringing that knowledge into a different domain, so that we can understand each other and communicate better with more a common ground on what the situation is.
Well, it's called knowledge exchange for a reason, isn't it? The exchanging of knowledge and the intersection of industry, from research to science to technology to policy and people. It's all about people, really, at the end of the day, that brings it all together. That's been amazing. Thank you, Malte. If people want to know more about you and your research, and they want to get in touch with you, where can they find you?
I'm a lecturer at the University of Sussex, at the Science Policy Research Unit. I teach students there on energy policy and climate change. And I would say probably use Google or your preferred search engine for Malte Jansen, and that should come up as my profile There's an email address there. I think there's a phone number there as well. But yeah, please do get in touch. Otherwise, LinkedIn, obviously.
Yep, and we'll put all those notes in the show notes, put all the links in there. And anything else within our conversation, we'll link people in. There may be overdubs over this with telling people what things are, but thank you so much for your time. That's been really insightful. Yeah. And let's do it again soon.
Yeah, that sounds great. Yeah.
Thank you for tuning in to the Energy Futures podcast. Here at Energy Futures Lab, we are dedicated to addressing global energy challenges through pioneering research, innovation, and advocacy. To learn more about us and the exciting projects we are working on, visit our website and follow us on social media. If you enjoyed this episode, please like and share and subscribe to stay up to date with our latest content.